Hello, everybody, and welcome to another one of IRONSHIELD Financial Planning's Fly on the Wall webinars. For those of you who don't know me, my name is Scott Plaskett. I'm a certified financial planner and the senior financial planner and CEO of the fee-based financial planning firm IRONSHIELD Financial Planning. If this is your first time tuning into a Fly on the Wall recording, let me quickly explain to you what this is. You're going to experience what it's like to be a fly on the wall during one of my update calls with a member of our Top Guns network. This network is my personal network of specialists. Every so often, I ask a member of my network to touch base with me to bring me up to speed on the latest happenings in their area. And when they call me, I record the call so you can be a fly on the wall for that call. On today's episode, I invited Mike Flux, Senior Vice President and Portfolio Manager at Connor Clark & Lund Private Capital, to chat about their investment outlook. We also discussed how to interpret the current events and how to properly position portfolios to take advantage of these market events. He shares a very well thought out and disciplined approach to investing in today's environment. Now, here's the call. All right, Mike, listen, thank you very much for taking the time today to go through our third quarter 2017 review and sort of market update on what's been happening and give people some clarity into what's going on at CC&L. So, without taking too much intro, I'm just going to pass it over to you. We'll just get started right into it.
That's great, Scott. Thanks for having me back. Looking forward to taking everybody through this. Just in terms of what we're covering, as always, I'll talk about some performance highlights, talk about the current investment market themes and our outlook moving forward. What are some of the key economic factors that are driving the markets? And at the end of the day, everybody wants to know what's your crystal ball? How are you positioning the portfolios today for what's coming? So we'll kind of go through all that. Quick update on quarter three. Won't spend a lot of time on this. We'll focus more on results to the year, but bond yields have risen up a fair bit. So we in 3 months we saw the bond market drop 1.8%. That was a bit of a shift in what's been happening in the market. And the 12-month numbers ending September are down 3% for the bond market. So all this talk that we've had in the past about interest rates moving up, when that happens, what's the impact going to be? We're really seeing that happening now in practice. Canada's risen rates a couple times. There's other markets around the world that are tightening or raising interest rates, and there's going to be an impact of that. Canadian equities had a great quarter. Not the best year. For the year, Canada's up 4.4% relative to global markets up double that at 8.8. But in the quarter three, Canada's up 3.7, which is quite good. And the U.S. and international markets had a positive quarter. One of the things that's been helping Canada is that the Canadian dollar is appreciated. So it's making the Canadian dollar look strong, but it's making non-Canadian investments look a little bit weaker in Canadian terms. So that's some of the impact you're seeing there. But overall for the year, you can see the international markets are up 12.3 relative to Canada at 4.4. So still that's been the better place to be. And that's what we've been favoring in our portfolio positioning. A quick snapshot, what's happening around the world in local currency dollars. So this is not in Canadian dollars, but you can see some areas that have really done quite well in the last 3 months. Up 10%, Mexico up 18%, in Brazil. Emerging markets generally doing quite well. Russia up 11%. So those are some, bit of a risk on trade, I guess, if you look at what's happened in quarter three. For the year, some of these numbers I've already shared, but international equities up 12.3, U.S. equities up 6.5, on a blended basis up around 8.8% relative to Canada up 4.4. So bias outside of Canada this year has been helpful. Last year, Canada was up over 21%. It was the best place to be. International stocks were down 2%. This year, it's shifted back in favor of global equities. So it really shows that you need to be active, you need to be tactical, you need to move money to where we think we can get the best risk-adjusted returns. Bonds for the year pretty flat, only up 0.5%, following the 1.8% slide in the markets. For the year, in local currency terms, a lot of pretty solid numbers up here. U.S. is a bit of a standout. Europe's done quite well. Brazil really done quite well for the year. Hong Kong, South Korea, some really great numbers here. So what's worked, what hasn't? In general, everything's worked really quite well. We've been a little bit biased towards stocks. We've been overweight outside of Canada. Short-term bonds and high-yield bonds have been good tools in the toolbox. When interest rates move up, you want things that are a little bit less sensitive to interest rates moving up. And high-yield bonds and short-term bonds do have shorter-term bonds in the portfolio relative to core bonds. So that's been a good way to diversify the fixed income part of the portfolio. Canadian equities value has done very well. Energy stocks have really started to recover a lot. Bank stocks, so value stocks have done quite well. Global equities and global small companies and real estate infrastructure, which we've talked about, every quarter now for the last many years, continues to be a really stable, long-term, tax-efficient cash flow and return. So that's really what worked. What's suffered a little bit, maybe on a relative basis, that growth stocks and small caps in Canada have not been the place to be. More safer stocks outside of Canada, global income and growth portfolios, dividend stocks have underperformed a little bit, and multi-strategy still continues to struggle a little bit on a year-to-date basis, kind of flat for the year. So we'll talk a little bit about that in a couple slides. But year-to-date, you can see the numbers for the markets in the purple, and how we did in the gold, and right across the board, short-term bonds, high-yield bonds, you can see the kind of value they've added. Canadian stocks, we get some stocks like Canadian Value that are doing a bit better than the market, others that are kind of in line. And here's the two areas that have been a little bit weaker, but we really have almost no money in Canadian small cap. It's really down to one of the lowest allocations that we'd make in that asset class. Global equity is up 8.8. Most of our clients are holding this global equity portfolio, which is up almost 10%. So some good outperformance there. Global small companies have done very well, and these are the areas that we've really been biased to. So it's great when you can get the absolute results, but also make the right decisions about having more money in those baskets. U.S. equities, we've done pretty well as well, up 6.8% relative to the market at 6.5%. And here you can see what I'm talking about in terms of income and growth equities. More dividend stocks have underperformed a little bit, but more of our clients are tilted towards the U.S. equity and the global equity portfolio that I highlighted. International stocks have done pretty well as well, in more or less in line with the market, but U.S. we've had a little bit more relative strength. These are 6-month numbers now for real estate and infrastructure. So real estate's up 7% year to date, infrastructure up 4.4%, multi-strategy a small positive return so far for the year, and it's more or less in line with the bonds, and that's really where we're taking allocation from. We're taking it out of core bonds, moving it into multi-strategy as a way to manage the interest rate risk in the portfolio. So while the absolute results have not been living up to what we'd hoped for the portfolio, on a relative basis, it's not like there's been a lot of opportunity costs, because bonds have not been the best place to be either.
It's very interesting, looking at this, because it really shows, when you spend the time and look at it, how the tactical overlay that you put on the portfolio is so important. Because, if you just left the portfolio in a balanced, whatever your mix was 5 years ago, and just left it, there'd probably be a heavy overweighting in fixed income. There'd be an overweighting in Canadian equities, and you'd have sort of your general exposure to the global equities. But you can see here how making those tactical shifts and saying, listen, it's time to overweight a little bit in the global equities and start to reduce our fixed income. It's one thing to outperform the underlying market, but when you consider in the bond component that the underlying market hasn't done well in any event, at the end of the day, you outperformed, but performance wasn't there. So it was actually a good call to have reduced our exposure to that particular. So the tactical is becoming that much more important, as I see it, just from looking at how the performance is sort of unfolding.
Yeah, we often talk about the tools in our toolbox, and if we just had one bond tool in the toolbox, clients would have been down 1.8% for the quarter, or only up 0.4% for the year. But the fact that we've got, we can reduce bonds in general, which we've done. We've got short-term bonds and high-yield bonds that have outperformed. We've got multi-strategy that's been a really good long-term contributor, and it's helped us to reduce our direct exposure to core bonds. And we've now got this new asset class that we can talk about called private loans, where we'd expect more like a 7 to 9% return relative to bonds at 1.3% moving forward. So we really have been quite aggressive about trying to tactically and strategically manage the risk that we see in the bond market in a rising interest rate environment. Now, multi-strategy, I've talked about some of the short-term pain maybe, where there still is positive results. But if you just look at the last 3 months, where bonds were down 1.8, the portfolio is up 1.3. So performance really has turned around recently. The year-to-date numbers are kind of the same, a little bit below bonds. On a one-year basis, we've certainly outperformed bonds. So even in the short term, where the portfolio hasn't done what we wanted to do, it has been better than core bonds, and that's where we've taken the allocation from. But if you look at the 3-year picture, the 3-year annualized returns are up at 7.4% annualized relative to bonds at 3%. And over 5 years, it's 10.4 relative to 3.1. So, certainly it's served its purpose over time. It's rare to see the portfolio underwhelmed like this for a period of time. So certainly we're still a fan. We're sticking with it, and we expect better things ahead. So let's turn to talking about investment market themes and outlook. This chart I've shared. It's rare to see a chart where 4 out of 4 quarters are going to be positive, and it's great to see. We probably do expect a little bit more volatility ahead, given how strong things have been. If you look at Q4 2016, Q1, a couple quarters up over 4%. A bit of a flattening here in Q2, in part because of interest rates going up in Canada. There's a little bit of uncertainty in the market around whether or not Trump could actually get through some of these tax cuts corporately, personally, that he talked about, the $1 trillion of infrastructure spend. And then now things have kind of resumed to a more positive market here. And really what's been driving the markets, it's not rocket science. Stock prices tend to follow earnings. And if you look at the earnings in the market in the gold, you can see what earnings growth has been on a year-to-date basis in Canada, the US, international markets, and emerging markets. And there's a pretty high correlation between total returns and earnings. Almost 100% correlation in international and emerging markets. A little bit of divergence here because emotion does come into play. But it's something you need to track. And if you think earnings are going to improve moving forward for companies, that's a good thing for the stock market. So you do have to track that, and that's been very favorable. There's a little bit of talk about, are things getting a little bit high? I mean, there's talk about record highs from one day to the next in the TSX or in the US indices. And there has been a fantastic recovery since the bottom of the market in March of 2009. But if you just look at kind of valuations, the MSCI World Index is trading about a 16.6 times earnings multiple. The US is running a little bit above that. The US market certainly has done very, very well. Canada and Europe are looking a little bit less expensive to the US. So when we think about where to buy, you want to think a little bit about relative value and the future trends, and so that's why we're sharing some of these stats. Bonds we talked about, interest rates have started to move up in the short term, and that's caused some selling. There's a little bit of short-term pain in the bond market. The other thing that's happened is that you used to get a fair-sized premium for corporate bonds or high-yield bonds over Government of Canada bonds. You can see how that spread has really narrowed down. And to put in perspective, there was a point where in 2008 after Lehman Wonder, where TD Bank went from paying 1.5% more than Government of Canada to paying almost 4% more than the Government of Canada. Those are the kind of times that you want to really lean in and buy into corporate bonds, because it doesn't make sense for TD to have to pay that much more. And you really want to buy when the spreads are the highest into the corporate bonds. And as the spread narrows, you benefit from it. But if you're looking to place new money today, a little bit less of a relative opportunity today with only about a 1% spread above Government of Canada bonds. So, where we would have been very, very heavy into corporate bonds back in 2008, 2009, when some of the tougher times happened, we've now reduced our exposure a bit. We still favor good quality corporate bonds, but we're being a little bit more selective given how well those bonds have done in the last 4 to 6 years. Returns remain low for traditional fixed income. I mean, this is just kind of the yields that you're getting within the portfolios. Actually, this is more the forecasted, the next 10-year forecasted return. Yields are low, and if interest rates are moving up, the yield you're getting is a fair indication as to what the return might be. And if interest rates go up quicker than that, then returns could be even a little bit softer, like what we've seen in the last 12 months. But our forecast for the next 10 years is that short-term bonds do around 1.6, core bonds have a little bit more interest rate sensitivity, do 1.7. High-yield bonds are earning over 4%, so we think that's a reasonable return expectation in the next 10 years. But then if you look at something like private loans, where we'd expect a 7 to 9% return, multi-strategy, where we'd expect, say a 5 to 6% return or better, there is some alternative asset classes that you can incorporate into a fixed income approach to help enhance the returns and help to manage the volatility. What worked in the past is not necessarily going to work moving forward. We're working in a very different market environment for fixed income, and we can't rely on that for 5+% returns. If it is 1 to 3, and stocks do 5 to 8, let's call it 6 to 7 conservatively, then what is a balanced portfolio going to do? It's going to be a real challenge to get over 5% returns in that kind of environment, unless you think outside the box and find other ways to diversify, right? I'm going to incorporate a couple slides here on what's happening with the dollar and oil. The questions always come in. And we saw the Canadian dollar spike up a fair bit recently, up to around 83, 84 cents when Canada raised interest rates sooner than expected. At the end of the quarter, it kind of ended up closer to around 80 cents. And now it's kind of dipped back down below 70, below 80 cents because the U.S. is probably poised to raise rates now. Canada's going to stay on hold for a little bit. So interest rates do kind of drive currency. Energy moving up and down drives the Canadian dollar as well. And you can see there's some times where we're obviously quite overvalued on the Canadian U.S. dollar exchange rate, and there's times where we're undervalued. Right now, we're probably trading at pretty fair value. And at the end of the quarter, when Canada had just gone through a big currency lift because of interest rates going up, you can see that we track certain things to kind of assess, which currency is going to be favored. And at that point, the U.S. would have been slightly favored relative to Canada. The only thing that was really working in favor of Canada is that energy prices had kind of popped back up a little bit, and that does favor the Canadian dollar. Interest rates have gone up, and that created some short-term opportunity. But in general, the U.S. dollar is probably still looking a little bit stronger. Now that it's corrected down to kind of the 76, 77 range, we're probably looking at that being a pretty fair range for the Canadian dollar exchange rate. We've seen a fair bit of volatility in oil too, and actually would probably correlate a fair bit if we line this up to the currency chart. But there was just back in 2013, we were $110. And you've seen how that's come all the way off down to about $26, $27 just recently. And now we've seen things kind of bounce back up to about $50. So there's been kind of a gradual move back up. And so there is a positive trend in that area. And that's been good for the Canadian markets in general. Last year was a great year, as I said, up over 20% in the Canadian market. The Canadian dollar kind of boosted back up from a bit of a low point. We see things probably being pretty stable in this range. Over the years, we might see it kind of slowly move up towards that $60 mark, but we don't see a lot of downside volatility from here. Now, if you look at just where are we right now, in this economic cycle, putting in perspective versus past ones, and what we're looking at here is cumulative real GDP growth from the prior peak, and so you can see the number of quarters, so 3-month time frames, how long it lasted. Here's where we're in the current expansion, and so you can see, it's been running a long time now. We could go a little bit longer based on what we saw in the 2000 market environment, but you can see the total cumulative real GDP growth is still well below where it was in the past. So just something to put in perspective, as good as things seem, we still are trending well below what a normal growth period looked like. So there could still be some legs left in the market. What's been happening in the global economy? I mean, here we're looking at some manufacturing numbers, Purchasing Managers Index, and we're looking at global real GDP growth. And you can see there's a pretty good correlation between the two over time. And global Purchasing Managers Index numbers are improving. And so that will continue to drive positive GDP growth. So we're still very much in a growth market environment. Even if things are growing, maybe not the same fast pace. That's a reasonable time to be invested in the stock market because things are trending in the right direction here. Now, if you look at the global economic environment, looking at things like economic growth, is a weaker, stronger, kind of leveling out. Things have kind of leveled out for economic growth, and inflation, monetary policy is starting to get a little bit tighter. From the economic growth standpoint, it's been positive, but it's been kind of unspectacular growth to continue. And we don't think it's going to be booming numbers in 2017 and 2018. So you just got to take that into consideration. Some of the key risks are China. Are defaults going to continue to are they going to rise? Is there going to be a harder landing in that market? Are interest rates going to shoot up a little bit faster than expected? Canada's had a couple rates. Politics is certainly a key consideration south of the border, even in Europe and other parts of the world. Inflation, the energy-related rise has kind of run its course. Labor market and wage outcomes are now kind of more center stage around, are we going to see wages grow? Because if wages grow, that does tend to lead to increased spending. And so there's a little bit of uncertainty in the labor markets that we just got to watch. Monetary policy, Canada, like I said, raised rates. Bank of England is looking to tighten near term. Bank of Japan, the European Union is is still considered committed to bond purchases, but if they start to raise rates as well, then that's something we need to watch. So this is what the U.S. Federal Reserve has been doing in terms of. Here you can see the U.S. Federal Reserve plans to reduce assets over time, de-risk a little bit, take a little bit off the table. And while inflation remains low, it's anticipating higher wages. So that's a positive trend. We've talked in the past about the Trump effect, and that actually has caused a little bit of volatility this year. One of the big things that he was elected on and which helped elevate the markets is the corporate and personal tax cuts. Deregulation should lead to a boost in the U.S. economy because it'll strengthen the U.S. corporate position. It'll bring more jobs to the U.S. The infrastructure spend, the $1 trillion he wants to spend, those are the positives. For Canada, particularly the trade barriers that he wants to put up, renegotiate NAFTA, geopolitical risk, restricting labor to the U.S. Those are some potential negatives. But on the whole, the markets have reacted very positively to the personal corporate tax cuts, the $1 trillion of infrastructure spend. And as I said, in June, July, when it looked like there's a little bit more uncertainty around that, we saw a bit of a market dip. We've now seen a bit of a recovery now that tax talk is back on the table. So the U.S. outlook is not as strong as Europe and other developed nations at this point. And here we're just showing private investment and consumption. That could potentially trend lower. Things have been very good for a long time. And so we've shifted our focus a little bit more outside of the U.S. into the international markets a little bit more so. But having said that, the manufacturing sector is still improving. So that's a positive trend. Canadian economy has been growing by strong consumer. Unemployment rate has been dropping. People are employed. The economy is in pretty good shape. Retail sales are moving up as a result. But I think something we need to watch in Canada is the increasing debt levels as a percentage of personal income. And if you look at people's net worth, a lot of that is coming down to the housing market and the strength of that. So, what would happen if interest rates continue to move up here in Canada, and how resilient will the Canadian consumer be when their mortgage rates go up as a result? Potentially the housing market softens, and there's some pretty significant debt levels out there. So it's something we're watching very closely, but it's one of the reasons that we're favoring equities outside of Canada at this point. European economy is improving. Here you can see the GDP growth. It's kind of trending up slowly, positively. But there's certainly strong growth on increased domestic demand. Unemployment has dropped a whole lot. You can see where we were back in July 2003. Current environment is quite a bit lower. Not nearly as good as Canada or the U.S., but certainly the trend is moving in the right direction. Chinese growth is kind of moderating a little bit. It was certainly a big growth economy for a number of years, but things have leveled off there a little bit. So we covered off a lot of what's happened in the past from a performance standpoint, what's worked, what hasn't, what do we see happening in the market today, and what is that leading us to in terms of portfolio decisions. On the whole, we really like global equities much more so than Canadian equities. These are the areas that we favor. These are the areas that we don't favor as much. Global small companies is probably our favorite traditional asset class. We think small companies around the world are looking to outperform. So we're overweight global, overweight small cap in particular relative to Canada. Bonds, we don't really like bonds or cash much at all right now. If where we are doing something, we probably favor short-term bonds because there is less interest rate risk attached to that. And, we talked about our 10-year forecast. Short-term bonds are probably going to do 1.6. Core bonds could maybe do 1.7. For the extra interest rate risk in core bonds, you're not getting, you're not getting a risk premium there. So we do favor short-term bonds over core bonds. And we're looking for ways to diversify it. So things like multi-strategy, which we talked about, private loans where we'd expect 7 to 9% returns. Those are some areas that we really favor. Infrastructure, real estate that clients have had an experience with, and there the return goal is 8 to 11%. Those are some areas that we're a little bit more optimistic on. So where are we in the market cycle? you can see this is what a typical market cycle looks like. You kind of go through a recovery phase, and then you go through the expansion phase, and then you kind of peak out. Eventually, you got to go through a contraction before the recovery resumes. And we think we're probably in the seventh inning stretch of a nine-inning baseball game. So it's something that we're very cautious of at this point. While we still favor stocks, we're not going significantly overweight stocks. In fact, we're kind of sticking to the risk return model. So if it's a 60-40 portfolio, we're going to be about 60% stock. And we're going to lean into the areas that we favor the most, like global equities, global small companies. But at this point, we just feel that a prudent, diversified portfolio makes sense. And even though stocks do have a better absolute return, there's maybe a little bit increased risk at this point. So we're just looking to be very balanced about how we're getting our exposure there.
So is this a point where you would say that people need to really, I guess, be aware of the patience that's now going to be required? I mean, going through this, the recovery and expansion phase where we, it felt great, it looked good, it was nice to get your statement every month or every quarter. You take a look at it, everything's up, and you move on with your day. Now we're at a point where you say potentially at the seventh inning of a 9-inning baseball game. So we're sort of in that, as you say, in that circle where it's kind of maybe at the beginning of the peak, maybe at the peak, maybe we're in and around that point. But then there's a period of what I call the patience period, where as the contraction takes place, it's a little more uncomfortable, it's a little more unsettling. But really, that's where the opportunities really start to present themselves. So that by the time we get to the bottom of that contraction phase, that's where the opportunities are just staring us squarely in the face that we can now take full advantage of. Which I'm assuming at that point is when portfolios that were right on mandate of 60-40 would then suddenly be tilted towards whatever the favorite asset class. Is that a fair assessment of things?
Yeah, for sure. And as you go through that phase, and we're not there yet, by the way, and this business cycle could last a little bit longer than people are expecting. Right now, there's still there's quite a bit of positive momentum out there. So we could be in the expansion phase, for some time before the contraction happens. But when that does happen, you tend to want to lean back into maximum overweight to risk. Canadian equities tend to outperform global equities in that kind of recovery phase. Energy tends to get a nice boost in those kind of market cycles. You want to lean into things like high yield bonds, over core bonds, when the credit spreads are at the widest. And think back to 2008. Anybody that bought in March 2009 is looking quite pretty today, right? TSX dropped down to close to 7,000. Now we're back up. We crossed 16,000, but we were at 15,300 in July of 2008. So you got to take advantage of these opportunities when they happen. We don't think we're there yet. We're still certainly still favoring stocks over bonds, but we're just taking a very prudent, diversified stance at this point. We're de-risking a little bit. We're shifting more towards growth-oriented equities. We've reduced our exposure to credit or corporate bonds, high-yield bonds. I showed a chart before that the spreads are really narrowed, so there's less of a relative opportunity. But in times like this, the alternative investments in a prudent fashion make a lot of sense because, in good times and bad, the alternatives tend to provide a stable, long-term, tax-efficient cash flow. In the case of real estate and infrastructure, so we favor those areas.
Yeah, no, I think the key word of what you just said is stability. It's now we're looking for that stability going forward to allow us to sort of ride off the next handful of however long it takes to maintain that stability, so it keeps us engaged and it keeps us moving forward. It's not going to be necessarily a huge outperformance per se, but the stability is what's going to keep us confident moving forward. And it's the traditional assets, or should I say, like the typical assets, the bonds that people have been used to, that are going to be hard pressed to continue giving us that stable.
Mm-hmm. Yeah, that's and when you got these kind of market risks out there, it's a normal market. Okay, there's always market risk, but I've talked about the housing market in Canada, consumer debt running high. U.S., we got a lot of political risk. Investor optimism has been very high. The market's done very well there, and that's usually a time to get a little bit pessimistic. So we're being a little bit cautious in that regard. A lot of political risk in European nations in general. Brexit negotiations happen in the UK. Debt levels are high in China and Japan. Interest rates are moving up in China. Japan is facing the risk of deflationary market environment, which is not good for current consumption. So I'm not trying to create a gloomy picture here, but there are some things to be concerned about. But then you've got all these positives like earnings growth and manufacturing numbers are positive. And so that's kind of a normal market. You got to look at the good, the bad, and the ugly, and then decide what is the best path forward. If you just look at, there's a range of investment options. I mean, a lot of clients would be invested kind of in a 55-45 balance mix or 60-40 or 75-25, but it just kind of shows the expected return and the kind of risk that you're facing. There's a different way of looking at risk. It's the chance of a 20% decline at one point in time, say in the next 10 years. And the chances aren't high, right, for a balanced portfolio that's diversified. You're moderating your risk by diversifying into a mix of stocks and bonds, but you'll notice that the returns are not what we have come to like and expect. I mean, you're looking at returns kind of in that 4 to 5 range. Take on more stock, maybe you can get up to 6, but 7 or 8% returns are not going to be easy to come by. If stocks only do 5 to 8, let's call it 6 or 7. Show me a scenario where you can do 8, right? And bonds are doing 1 to 3, right? So we're just trying to be realistic here around the simple math of what's practical. And this is not different than what any other institution's facing. You look at pension plans, you look at foundations, endowments, high net worth clients. Everybody wants a reasonable rate of return. And in 2005, to get a 6% return, you could do that with the majority of the portfolio in bonds and less than half the portfolio in stocks. And your chance of a 20% decline was very low, only 5%. But if you wanted to accomplish the same thing with traditional assets today, you'd have to reverse that quite a lot and go to almost 100% equity. And look what happens to your probability of a 20% decline. It goes way up. So meeting in the middle, what you can actually do is you can increase your bonds a little bit, reduce your stocks, and increase alternatives, versus this scenario. Maybe that's a better way to go, right? You get the same kind of expected return. Probability of a 20% decline is still going to be a little bit higher than what it might have been when you were heavy into bonds back in 2005. But it's certainly a lot lower than if you're just leaning into stocks to chase that return. So, our answer to that is 5 alternative asset classes, including multi-strategy, which we talked about, real estate, we're investing in commercial, industrial, retail, real estate in high demand, low supply markets of Canada, ideally buying into buildings trading at below market rents. We had some decent capital calls recently here. You can see a property in Hamilton, a shopping center in Nanaimo, BC, and a couple properties here in the GTA. We've had some good activity in our infrastructure portfolio as well. We made a new investment outside of Canada, the first one into the market of Chile. And if you look at Chile as a credit rating compared to Ontario, believe it or not, it's actually rated higher than Ontario from a credit rating standpoint. It's a very democratic country that's very open to foreign investment. So we've certainly done our homework with our solar partner on that before we invested, and we're feeling quite good about the future in that market. And we've also been having opportunities to buy out partners of solar assets. So we just had a recent capital call on Windsor Southgate in southwestern Ontario, where we were able to buy out our partner and expand our equity ownership of that asset, which has a very attractive 20-year risk-return profile. Private loans, which we just launched earlier this year. Here we're looking to make offer loans to public-private companies that would be mid-sized, but large mid-sized in our opinion. So like 100 million plus in enterprise value, 10 million plus a year in earnings, 75 million a year in sales would be a kind of a floor profile that we'd be looking at. And the first loan we made was for $40 million to a company called Vertex. And they're a service provider to the municipal oil and gas and oil sands markets. So it's kind of a required service. And we just had a second transaction as well, also about $40 million to a Quebec-based IT company that's focused in the healthcare space. And both these companies have a very attractive, stable EBITDA and cash flow profile over the last several decades. We've had experience lending to these companies before through G Capital, which is where our team came from. And what's interesting about these loans is that you have security on these loans, unlike a public market bond where there's no security. If there's a bankruptcy, chances are you're losing money. Common shareholders will lose their money first, followed by preferred shareholders, then followed by public bondholders. But secured creditors that have issued private loans will get paid first. So there is security in these kind of structures. Plus, these loans are negotiated based on a floating rate of interest, banker's acceptance rate, plus some kind of rate of interest. So when interest rates went up a couple of times, like they did in Canada, that means it's leading to higher interest rate on the loan. So in a few regards, we think this is a very favorable asset class. It's not just for the 7 to 9% returns that we expect. In several ways, it's a less risky asset class than traditional fixed income. So if you look at all the tools in the toolbox, if you will, here's just kind of the standard risk return chart. You got return on the vertical axis, you got volatility on the horizontal, and you can see how things kind of follow this trend line: more risk, more return. But there are 4 asset classes that pop off that curve where they offer more attractive volatility or more attractive return, or both. And really, that's what we're trying to do, is find more investments up here in the northwest quadrant. If we could find something up here, we'd go for it. But that just doesn't exist. It's not an easy market that way. So we've had to be very innovative, and we've brought different alternative asset classes to the table to help diversify our clients' exposure to traditional assets. So, if you look at a range of diversified portfolios, here's kind of a 60-40 portfolio, stocks and bonds. This would be 75-25. Over here, this would be 35-65. What we can actually do is work to generate a reasonable rate of return. 6% would be the average return we'd expect in a balanced portfolio like this that incorporates these alternative investments, multi-strategy, real estate, infrastructure, private loans. And your range of returns the next 10 years are probably looking to be somewhere between -4 and +17, 80% of the time. 10% of the time, the returns could be higher than this. 10% of the time, the returns could be worse than that. If something unprecedented like 2008 happens, certainly the returns will be lower. But it basically just shows that you can get the returns up from what could have been below a 5% return to something a little bit more attractive, and capping the downside as well by incorporating these asset classes that have a pretty attractive risk-adjusted rate of return. I thought I'd just end on this slide. This is just talking about the growth of Conococheaguan Private Capital since '98, and I started back here in 2003. So I've been very fortunate to watch the company grow over the past many years, and we've grown in people and asset classes and systems, and we're now over $7 billion as of a few weeks ago. So we're very happy with the progress, and our commitment to you is that we'll keep on innovating. Some of these alternatives that you've seen in the past, hopefully there'll be more stories we can share with you over the years ahead. But we're always going to be thinking forward as to what's coming down the road and what can we do about it to benefit you. So hopefully everybody's happy, and we'll try to keep things going.
Thank you for listening to today's call. If you require further information or have a question relating to today's call, please go to the comments section in the show notes below. Ask your question or make your comment, and we'll respond directly online. If you would like to take advantage of a free, no-obligation appointment, please call me at 416-626-6515. Or you can visit us on YouTube by checking out our YouTube channel, youtube.com/IronShieldCFP. Follow me on Twitter, twitter.com/IronShieldCFP. Like us on Facebook, facebook.com/IronShieldCFP. Or you can connect with me on LinkedIn.